So welcome back. Now so far we have discussed what is behavioral finance, why and how finance is affected by behavior, and we have also discussed the prospect theory and the origin of behavioral finance. Now in a very logical and simple manner, we shall try and discuss the relevance of this behavior finance in your life and how can you apply it in your day-to-day life in this today's financial world. All right. Now, if you are watching this course, then it is very likely that you are a person who is earning some income. That income may be through your salary, through your business, or maybe through any other source. And with that income, a portion of that income you may use for your monthly expenses, and the residual income, whatever remains unspent, that you may invest or you may save. That residual income you may either keep in a locker at your home or you may invest that money for growth. Either of these two things you will be doing. If you keep your money at home in the locker, then inflation will decay your money. Inflation will eat away your money. So this option is not desirable. So what do? For growth, you either put your money in some fixed return instrument, a bank or something like that, or you may put in some variable return instrument for growth. What is that? If you are putting your money in a bank, then it provides you adequate safety, but the returns are quite limited. The returns may be, just enough to beat the inflation or maybe slightly more. But if you are expecting a higher return, then you may invest in things like real estate or gold or maybe stock market or maybe mutual fund, commodity, currency, crypto, crude oil, or many other things. But here it is a variable return. What does it mean? See, the returns are not guaranteed and the returns carry risk. As a general rule, if you are expecting high returns, then you must be prepared to take high risk. And if you are not prepared to take high risk, then you may not expect high returns. All right. So having said that, generally about 1 month requirement of money you will keep at home in your locker. About 6 months requirement of money you may keep in the bank, maybe liquid or maybe in short-term fixed deposits. And then your retirement corpus or the money which you may use after several years for your marriage or for your children's education, that probably you may keep in some fixed assets like provident fund or government securities or bonds or certain other things. But by and large, if you are in the age group of 20 to 50 years, then most of your investment will be growth oriented, will be in either of these things. All right. Now, with this in mind, let us see how behavioral finance is relevant to you and how do you use it in your life. Let us see that. Keep these things at the back of your mind. All right. Now, consider that you are investing your own money. You have adequate financial knowledge and you are investing your own money. You are not taking anybody's help. In that case, what will happen on a routine basis, on a daily basis, the news channel and the people, the panelists who are discussing on the news channels, they will try to influence in different manner. When you watch them, you will get influenced by their talks. And then the big players and the financial institutions which are there in the market, their behavior, their actions will have an influence on your mind. If the big players, the financial institutions are purchasing in huge quantity, you will also be tempted to purchase. If they are selling, you will also be tempted to sell. But you may not be aware why they are purchasing or selling. You are just getting influenced by their actions. And then the public at large, your friends, your colleagues, your neighbors, your family members, they are also reacting to the news and the situations, and they will discuss with you. And when they discuss with you, it will play on your mind, on your sentiments. Your own fear and greed will constantly play on your mind. If you are invested and if your investments are growing, you will feel more and more greedy. If your investments are going down, you may feel more and more, scared of your money. Then the temptation to invest in rising market, the fear of missing out. And when the markets are down, you may want to exit. These pressures will be there on your mind. And then if you are fully invested, you don't have any money left with you, and suddenly some requirement comes up like a wedding at home or some holiday plan, then you may be under pressure to liquidate your investments. All these psychological pressures are on your mind always. But if you understand behavioral finance, then these noises will not affect you. Your knowledge will help you in guarding against these influences and these noises. You will base your decisions on your knowledge, on facts and figures, not on all these disturbances. Got it? Now suppose that you are not investing your own money. You are a financial advisor or a consultant who is advising other people. In that case, what happens? You have to advise your clients and motivate them to invest. You have to play with their psyche. Only when you are able to convince them, only when you are able to play with their psyche, they will get motivated and invest with you, isn't it? And then when the markets are in a turmoil, when their investments are dwindling, you have to hold their hands. You have to provide them comfort and confidence. You will have to explain to them that don't worry, your money is in safe hands. And then when you are advising your clients, you may have to work out different investment plans for different people depending upon their psyche and sentiments. Some people are aggressive investors. They are willing to take high risk. Some people may be very conservative. They may not be willing to take any risk at all. So you may have to prepare different plans for them. Even for the same person at times, you may have to propose different plans for different time horizons. Small term investments, medium term, long term. In different manner, you will have to explain the different investments to them so that their psyche understands and they take decisions which are in your favor. So if you understand behavioral finance, then you will be able to help in guiding and convincing your clients and winning over your clients. Got it? Now suppose you are not a financial advisor, but you are a mutual fund manager, or maybe you are working for a mutual fund company. In that case, how is behavioral finance relevant to you? See, in that case, if you're working for a mutual fund, then you may have to advise your clients and motivate them to invest. And when the markets are in a turmoil, you will have to manage the public perception and sentiments. Because when the markets are in turmoil, people may want to redeem their investments. They may want to, withdraw their investment. At such times, you will have to manage their perception and convince them to remain invested. You will have to design the marketing plans and the marketing campaigns depending upon the psyche of the target audience, whether they are young, whether they are senior citizens, whether they are ladies or they are male. Depending upon their demography, you may have to, design your plans accordingly. Play with the psyche of that demography. And when the markets are down, that time again you will have to convince the public to remain invested and more. You don't want public to rush out and take away their money. Your mutual fund will collapse if that happens. So you will have to play with their psyche and motivate them to remain invested. Similarly, when the markets are rising, Again, you don't want public to withdraw their money. As a mutual fund manager, whether the markets are up or down, you always want people to keep pouring money into your fund, isn't it? So you will have to convince the public that don't redeem at this time, rather invest more. So if you understand behavioral finance, then you will be able to manage your fund very well. Got it? Now suppose that you are working for a financial institution. You are just an employee in a big financial institution. How will you use your knowledge of behavioral finance? Here you have to analyze the psyche of the masses and the small traders so that you can take advantage of the circumstances and opportunities. I'm not saying that you will do anything wrong or do anything which is unethical, but financial field is a very cruel field. There is no room for sentiments or compassion. You will have to understand the psyche of the masses and the small traders and then take advantage of the circumstances and situations in the interest of your financial institution without doing anything unethical. All right. At times, you have to manage the environment to prevent fear. In order to prevent the market from going down, you may have to manage the fear of the people. And at times, in order to prevent the market from going too much up, you may have to manage and suppress the greed of the public. So all these things you have to do as an employee, as a financial expert of a financial institution. And as a financial institution, always remember that your success depends to a large extent on the public perception. How does public perceive the money in your financial institution? It all depends on that. So if you understand behavioral finance, then it will help you in managing the public perception very well. So therefore, whether you are an investor, whether you are a trader, or whether you are an employee in a mutual fund company or any financial sector, whatever your role may be in the field of finance, behavioral finance is very much relevant to you, and you have to apply the skills and the knowledge of behavioral finance in your field of finance wherever you are working. All right. Now, how or what are the psychological aspects? What are the cognitive biases? What are the heuristics which influence your own behavior and the behavior of the masses, the public? That we will see and understand in the next section of this course. All right.